Hi, it's Dave. Welcome. Today we're joined by Tom Gardner. He is the CEO and co-founder of Motley Fool. They are a stock advisory service that was founded in 1993, and Tom founded this with his brother David. They're based in Alexandria, Virginia, with their headquarters. Tom, I wanted to welcome you on the show.
Dave, thank you for having me so much. This is how much of a fan I am of your work. There's my background.
That's awesome, man. That's great. You guys keep it fun, huh? I mean, is that one of your, like, kind of your core values to kind of have fun throughout the process?
Well, our mission statement is to make the world smarter, happier, and richer in everything we do. And David, my brother, says his favorite word in our mission statement is the word "and," because we try to achieve all of those together. And so we want to create a learning environment to help as many people around the world get started investing, get smarter about the investing they're doing. We want to have fun in the process and learn about the world that we're in. And yeah, we want to profit. We'd like to do better than the market's average, since we know we can just get that with an index fund. But yeah, as many jokes as we can make. And there's always some gallows humor and very bad times in the markets, but we are long-term optimists.
Hmm. I'm curious, Motley Fool, where did that name kind of originate from?
That comes from Shakespeare. It actually came from Bartlett's book of quotations that my brother was thumbing through when we were trying to select a name for our print newsletter in 1993. And he came upon a quote from As You Like It, a fool, I see a fool in the forest, a motley fool. And we began to reflect on the idea of the Motley Fool being our name. And the deeper we got into thinking about what we wanted to do, and we didn't have grand ambitions when we started, but Erasmus in Praise of Folly, there's great literature on fools being contrary to the conventional wisdom. And so it was also a very good disclaimer. You know, the first two stocks we recommended in our 1993 newsletter would both eventually go bankrupt. So you know, if we make a mistake in your portfolio, and we want to share our mistakes and the data around our mistakes to make sure everyone knows. Yeah, we're fools. You know,
Hmm.
we're all in this together. We're not pretending, or nor do we want to put on any airs and wear the suit and tie and sit in a wealth management firm. Not that there's anything necessarily wrong with that, but yeah, we're we're just trying to be as accessible as possible.
Awesome. Yeah, I've been hearing, a lot of people I interview have been actually highly recommending the Motley Fool. I have a friend, Emmett Peppers. He talks about you guys a lot. I interviewed another guy, Muji, Triple H Hypergrowth. He talks about Motley Fool and the benefit he's received from the community as well. I'm curious. It seems like you guys really have a super long-term focus. Like, this is kind of one of your kind of key defining things, where rather than being just swayed by just, I don't know, the whims of the market or stock picking, you guys are really looking to hold long-term, right? These companies that you guys really feel are long-term winners. I'm curious, part of me would think, maybe you could concentrate a bit, but then you guys also have this diversification value where you really want to spread out your bet somewhat. Where does that come from? Does part of that come from, like, from the early days where maybe you did learn from your mistakes that no matter how confident you are, there still could be kind of error, and therefore you need some type of diversification?
Well, you're honing in on two things I've been thinking a lot about in the last 12 months, but certainly as for 27 years, I'll say long term is probably one of the concepts that we hold dearest, and that comes as much from being passed down from investors in our family. And our dad invested for us as kids, so we got the account and we could see what the returns were. And thank heavens he held the Washington Post for all those years, because it helped pay for going to college. So we saw the benefits of it right there as young investors. And then diversification, I would say we're Motley at the Motley Fool, so we do have members, and we do have advisors and analysts who run more concentrated portfolios. I'm particularly a fan of diversification, and I'll highlight two reasons, although I probably have 24, but we don't want me to do that. The first is it's a wonderful way to learn about the world. So the father-son team of Walter and Edwin Schloss, who were money managers, Buffett was, I believe, in Benjamin Graham's classroom with the elder. And the Schloss approach was, whenever we see anything interesting at all, we immediately buy shares. Because we know if we have skin in the game, we'll start following it. And we know the way the human mind works, that even though it's a small position, we'll almost start thinking about it as frequently as a large position. And what we don't want to do, let's make it contemporary. What we don't want to do is miss out on gene editing or machine learning and artificial intelligence or SaaS when it's emerging with Salesforce or whatever is the next trend. We don't want to look at it, recoil, or be protective of the companies that we have. We want to jump out and learn about the world. So that would be one reason for diversification. The second reason is that if you diversify, there's many ways to define what diversification is, but let's just say 30 stocks. Once you have 30 stocks or 30 investments, you can then actually increase the risk. I'd say after your 20th position. So if you open 23% positions, let's just say the next 10, you can amp up the risk a little bit in those. And those open some alternative investments, some things that large wealth management firms aren't going to present because they look kind of absurd. They're not stable, dividend paying, been around for decades. They're Fiverr with 2 R's on the end. No, we're not going to recommend that and put that in our client accounts. That would be embarrassing to the firm, to the brand that we've built up for decades. So to me, the beauty of diversification, second beauty is we're getting to learn a lot about the world. And the second is we can actually start to, as I.L. Kusner on our staff says, we can lean into the risk and then diversify the heck out of it. So again, if we go endlessly far, okay, we just become an index fund. But if we have some constraint that we're looking for great long-term companies, and we're going to let our winners run. In fact, we're going to add money to our winners. So we'll just naturally concentrate our portfolio over time.
Mm-hmm. Got it. I'm curious with this idea of long-term investing. What kind of percent or what degree do you think long-term investing mindset works and is effective? Because simply it is like the best way, let's say, to think about investing companies, growth, et cetera, versus how much of the effectiveness of being long-term also is helped by the short-term attitude and the short-term bent of Wall Street. I mean, is that part of also why you guys have, really focused on this? Because it seems like the culture of investing, the culture of big funds is so quarterly or annually based. And then, I'm just curious, what's the genesis and background of kind of this long-term investing mindset that you guys have developed?
Well, it starts with data. And so when we look back, and there's an Arizona State University study that presents that over the last 100 years, 86 companies make up half of the stock market's capitalization. And really 1 in 25 stocks are driving the vast majority of the equity returns. And so what we want to do is find that 1 in 25. And we know that over rolling 10-year periods, about 2% of all public companies will rise 10x and hold that 10x. So not a temporary GameStop, but a more legitimate, sustainable business that's being built successfully in the public market. So that's 2%. So it's 1 in 50. And so if we find that, the last thing we want to do is let it go, because that's going to have the potential to drive a substantial amount of our long-term returns. Obviously, there are tax implications to holding, and if you're in an IRA or 401k self-directed, you maybe can be a little bit more active. But I think the data is really what drives us there. And I wouldn't say that we had this full perspective in 1993. I think we've learned and looked at our own data. We looked at our Stock Advisor returns, which is our kind of flagship service. It's about 18 years old. And so we've been picking 2 stocks every month. Sadly for me, my brother is destroying my returns. Thankfully, we're both beating the market. But what we did was did a historical study of the data. And we found some interesting things. I'll just share 3 of them. The first is if we had never sold a stock, we would have better returns. Because all it takes is selling 120x return too soon, and all of the smart sales you made on companies that didn't succeed, they're not going to add up to that enormous 20-bagger. So that's one. Number 2, we found that those members historically who had purchased 30 random selections of our recommendations and held them for 5 years. Looking backwards, now we do have the financial crisis and the pandemic, so we have some good data in these 18 years. Looking back over those 18 years, if you had done that 30 random stocks, 5-year holding period, you had a 97.6% chance of making money. And for many people, when they start investing, that's their primary ask. We all, as we get better and more interested, love the subject, want to improve our returns and hopefully do better than average. But for the majority of people who might start buying stocks, they want to make money. And so I think that 5-year data diversification sets them up for The probabilities in their favor. There are no certainties.
What would you say to the new investor or the person who's scared, who says, man, the stock market is so crazy, it's so volatile, the economy is volatile, everything, the whole world is so crazy. How do I know if I put my money into the stock market or into certain stocks that I will be guaranteed any of it back? What would you say to that type of kind of, fearful person as kind of a first step of what to do?
You are in control of your situation, and people can lead a very happy life without having equity ownership. So I don't attack your fear. I want to understand it, and then I want to just present some context and some numbers, and want you to understand that by keeping your money in cash, it will either decline in value or not gain value at all. And in the equity markets, you'll get a 10% return historically. But we know that 1 out of 3 years, the market will be down. So the moment you purchase, you could be down 10%. So let's say this person's built up a $300,000 nest egg. They may invest today if I persuaded them to go all in. And in 3 days, they could be at 270,000. We know that if it's happened before, it must be possible. We know the data shows the market falls 10% once a year, 20% every 4 years, 30% every decade, 40% every 20 years or so. So that could happen the moment they begin investing. So we have to work together to prepare that person for that possibility. And that would cause me to say, how about with that $30,000? You don't have any of it invested. Let's start with 10,000. Let's start with 10,000. We do not need to change your perspective overnight. What we want to do is get you on a lifelong path to building wealth for you and your family. Excuse me. And ultimately, your children will benefit from seeing that they can have a stake in society and in business and profit from it. But let's go step by step.
Great. How about the recent Fed money printing? We're talking about trillions of dollars being created, balance sheets, of the Fed expanding. You're having super low interest rates, debt increasing. And does this all make you more bullish for equities as people maybe look for something as a safeguard to inflation? Or does this increase kind of some uncertainty long term in terms of just the stability of the markets? What are your thoughts?
Well, I think a lot of the relief aid has been necessary. Some of it has been mismanaged, and that will happen. There will be corruption. We will find that, and I wouldn't necessarily call it corruption, but you did see companies giving back their PPE funding when they really didn't need it, and that's not what it was for. So whenever that happens, there's inconsistencies and waste. So we would want it to be as limited as possible for the waste, but it's necessary. That will have the impact of degrading the value of the dollar and of currencies around the world, which is one of the reasons to be optimistic and interested, at least in considering having a couple percentage points of a portfolio in Bitcoin. But I would say that long term, that capital, I'm stating the obvious, sorry, I don't have any deeper thinking, but long term, that capital needs to be productive. I am a believer of universal basic income up to a point, but I actually believe a greater contribution would be universal basic investment, where it's very easy to get $50,000 to start a company. Because with machine learning and AI coming, we're going to need a ton of new companies for employment reasons and to be productive and to compete. So I would say universal basic investment, if the government could set up policies, or the FANG companies could take 5% of their balance sheet and put it into a fund that was run off an app driven by machine learning to help people get $25,000 to start a company. That is more, that makes me feel more confident in what happens through this terrible situation that we're in. The more that capital is distributed without a plan and does not lead to productivity, the more the markets become unstable, and these short-term games that we see with AMC and GameStop, aspects of which I like actually, but other aspects of which are not leading to productivity. So I would say that I'm probably, I see the necessity of it, but I think it slightly destabilizes things by its very nature. And so and certainly I think that we're at historically high valuations. So I would say that the default setting for most individual investors in the stock market should be to have 10% of their portfolio in cash, even though that cash will decline in value over time.
When you look out 10 years into the future, I guess first is how bullish are you? Like your bullish kind of optimism and hope, is it based largely on the entire market itself, or is it really just based upon individual companies? Meaning, do you think the whole market, are you super confident the whole market will be a lot higher than it is now? Or are you more just saying, I'm not sure about that, but I'm really confident in these best of breed companies that we've chosen? And if so, kind of what are the reasons that, if you are super confident in the market, what are the reasons for that? But if you aren't, also what are the reasons why you might not be?
If I took any average 10-year period throughout history, I would say going into it with a long-term optimistic view about it is a good idea. I think that the chances that you will lose money over a rolling 10-year period is quite low, particularly if you're adding new money. If you can add new money every 2 weeks, every month, every quarter, you really shouldn't be that worried about market declines, particularly if you're, let's say, under the age of 50 or even under the age of 60, given how long, hopefully, we'll all see our life, our longevity expand here. But so I would say if you have that 10-year time horizon, you should be pretty confident that you might marginally lose money, because there are 10-year periods where you lose money. But overall, you should be comfortable that you're going to break even at least, which I know isn't highly satisfying. But remember, if the overall market just breaks even in 10 years, you're still keeping up with everyone else out there in the marketplace of equity ownership. So that's number one. I would say I'm actually probably a little bit less bullish than an average 10-year period right now. I think that I do like to look at some market indicators. Our father is a macroeconomist and is really focused on that. It hasn't been a core aspect of Motley Fool investing, but I would say that if you look at some historical guides, you would have to say that the market is richly valued today. Now, why I wouldn't divest of positions is that I do agree with the other aspect, is subtext to your question, which is that there are many markets within the market. So there are new categories emerging. There are very well-run businesses. There are businesses that are being sidelined because they didn't innovate. And so there's always an opportunity. There's always a 10-bagger sitting out in the market for us to find. And if we can work on it collectively and find the factors, we can get, I think, very pleasing returns pretty much in any 10-year period in the U.S. system. So I would say I'm slightly less bullish going into the next 10 years. But if you let's take the SaaS companies just as one component. So obviously, if they have high DABNR, high growth rates, high gross margins, and now they're layering in machine learning, the ability to automate at scale and therefore to use massive amounts of data to solve complex problems instantly in a 24/7 way. Apply that to any category, any aspect of business. The implications are that customers will get better guidance or better results from those solutions, and they will actually cost less to provide because you're using applications to do it. So we should see higher retention rates and higher margins for the very best companies. And I would say that their next decade looks very bright.
Mm-hmm. So with the advent of, let's say, machine learning, artificial intelligence, you have major tailwinds from even the computer revolution, the internet revolution. We're talking about major disruptions on historic levels right now. When you look at the next 10 years with all of this technology, and AI might be even the biggest one of them all, who knows, but would you foresee the gains being more concentrated in terms of there's a smaller number of companies that really benefit, let's say, from AI? Or do you envision a scenario where the gains are broadly distributed, where lots of companies benefit from AI, even non-tech companies, because they're able to, let's say, garner the services of AI companies, to maybe modernize their operations? What are your thoughts?
Dave, what I want to do in the second half of the interview is ask you all these great questions. When does Dave leave? When does Hey Dave get interviewed? Does that happen? I want to turn the table. Can we get a few people? Can we get Emmett and one or two others that you've interviewed? Well, interview you?
Well, that's the point where sometimes I love, I originally asked you for a 2-hour block or something longer, because some of these questions are so fascinating to me. I feel like they deserve longer discussions as well, from multiple angles. But yeah, I mean, definitely, if you want to go longer, I'd love to talk longer. But I'm so curious, actually. I'm sincerely like, I want to pick your brain with this stuff. This is so fascinating, what's going on in our world. Yeah, so yeah, I'm totally open-minded though.
I agree, and I'm really honored and flattered to be asked by you to have this conversation. So thank you
Awesome.
so much. I would say that my personal belief, and I'll qualify this by saying, if you look at the data of my investment work going back decades, I'm generally right from a stock picking standpoint 60 to 70% of the time, and wrong 30 to 40% of the time. And some of those 30 to 40% are luck and coffee. And thankfully, some of the other ones are Tesla or Appian or Shopify, and the gains cross out the losses. The math works out pleasantly, as I know as a Tesla shareholder for a long time, and it can cross out some good mistakes out there. Okay, so here's my belief. That's my qualification. Here's my belief. My belief is that software, technology in general, but software has been concentrating wealth. So we're creating companies where 11 people are working at Instagram when it's bought out for $1 billion. So when we divide that money up evenly between those 11, which doesn't happen, you're talking about $80 million per person for, I can't remember how long Instagram had been in business before the acquisition, let's say 2 years. So in 2 years, 11 people make $80 million. And had they held, or had they had a performance component that kept them as major equity holders of Instagram inside Facebook, is what they did. They got Facebook shares a lot, or they probably bought a lot. But overall, Instagram has gone on to be now worth a couple $100 billion. But that acquisition is an indication to me of where we're going and where we have been going for a very long time. And now, if you add in machine learning and artificial intelligence, there's the first step is, of course, it's going to be repetitious and monotonous work that nobody wants to do. So we'll all get elevated to the next level. But then the wave will roll again at the next level. What we think is repetitive and monotonous will be redefined. And it's going to create some tremendous opportunities for the tools providers in AI, for small expert collections of developers and data analytics firms. And some of them will go public. Many of them will be acquired. They'll be private. There will be a race for this talent. It's already happening, of course. But it's definite, in my belief, it's definitely a wealth concentrating dynamic, and it's going to require that we rethink everything. I mean, my two beliefs about that, things that we would need to rethink. One, we need many more companies. We already have a problem with people not believing that capitalism is a benefit to them and having a very good argument as to why it isn't. And we already see plenty of evidence of bias throughout organizations, throughout history, right? My mom was not invited to go to math class. So we can all look back openly to the past and to the present and see that there is unevenness out there. And we need an evening of opportunity, not of outcomes. People will win and lose, make smart decisions, make bad decisions, but we need an evening of opportunity. And that's going to mean we need to prepare young people to be involved in small organizations, growing organizations, trying new things. We know that most of the wealth of entrepreneurship, let's say over the last 30 years, has come from people who had a computer in their home when they were by the age of 10, 12. And we know that wasn't every household. So these forces are happening. Some of them are the result of terrible thinking. Some of them are just new developments that everyone's trying to catch up. What are the implications of this? But I think we're moving into a virtual world where applications can be created this month and can have worldwide customers within 10 months. And that wasn't the case during the Peter Lynch years of following companies opening stores and malls that had to raise capital and get leases and get product and manage inventory. Like the 9 Wests of the world are gone as dynamic business opportunities, and it's digital, and I think it's a wealth concentrating dynamic. So I think there are a lot of challenges about that.
Mm-hmm. I mean, traditionally, value investing has tend to focus on more stable companies that have had some history and have stable future, expected cash flows, et cetera. So you can come up with generalized, framework to value the company. But with the world that we live in, with so much information, so much technology, so many new things are popping up too every day. Does this change the game for value investing, where what we thought maybe 20, 30 years ago was a stable company with stable history and stable future in the decades, let's say 2020 to 2030, perhaps maybe they might not have as stable of a future because of the disruption of technology? Where does this leave, I guess, value investing into more stable companies? Like, is that still a legitimate growing field, or do you see its role changing in investing?
I think it changes and has been, and I think of people like Bill Miller who helped to change that thinking a little bit at Legg Mason, and that is that it shouldn't be only or even primarily about valuation. Value investing should concentrate on what creates value sustainably, less recklessly, let's say, perhaps with less volatility. We know that the best performing stocks in the public markets are the most volatile, but it doesn't mean those are the only performing companies. And the portfolio that my dad is interested in at the age of 82 is different than the portfolio I'm interested in, and different than the portfolio that my nieces and nephews are interested in. My dad would say 10 baggers aren't that compelling to me right now at 82. I mean, he's very much out in technology investing, but he's buying stabler companies. Like, he has, large positions in winning large tech companies, and has for a long time. But Dad has said to me, don't be a value investor in technology, because those companies that look cheap probably have missed the last innovation cycle, and it's very hard to leap back forward and be relevant. Usually it takes acquisitions, and that's got its own risk associated with it. So I would say value investing for me, if I were to define for the next 10 years that I'm going to be a value investor, I would focus on two things. I would focus on mid-cap and larger companies for the stability. When you start to get to large caps, historically over a rolling 10-year period, it's you have a much higher rate of profitability among those companies than small and micro caps, but you obviously have a lower return. So I'm going to trade the return for the stable businesses. And the second thing, just to trot out some numbers that won't make for good video, but if you begin to if we all begin to develop metrics around the stability of a company's growth rates and cash flows, because it's natural, and particularly in kind of boom times for the market, that you only want to buy the company growing 50% a year, or it's 38% a year and it's accelerating. Like, those become the only companies that people latch on, and you get a lot of momentum investing around that. And that's not necessarily bad, though. That is a great slice of companies to be invested in. But if you start to look at how they manage their balance sheet, how acquisitive are they? What's their goodwill as a percentage of their total assets? What gross profit do they generate from every dollar of working asset investment? So when we start looking at some financial metrics, we're going to lose a slice of innovation, and we're going to lose small and mid cap, but we're going to go very capital efficient mid and large cap companies, which to me, for example, would highlight Shopify and Zoom as more value investments, even though when we look at their valuation, value investors traditionally would throw their arms in the air and say that's insane. But from a value sustainability and low volatility, I think you're going to get it in companies like that, and ServiceNow. And that's not going to be Fiverr and Fastly and Cloudflare.
Mm-hmm. Got it. Fascinating, interesting stuff. I want to dive into exactly how we can pick these long-term big winners with a long-term perspective. And I guess the first thing is, how important are founders? And what exactly are you looking in founders that will help you determine, like, oh, this is going to be, or it has potential to be, a big winner? And are there, like, how can you be not tricked? Because some founders, they're great salespeople, they know how to talk the talk, give ambitious plans, but sometimes it doesn't turn out. So what's your kind of feedback, advice, thought process with founders and their role?
Well, one of the for the study of investing throughout our lifetime, I think a fun exercise for people to take on is to see if they could select winners. They could just do it don't have to put capital in it. Select winners just based on a single factor. So let's just say growth rate. or let's say product innovation or qualitative, let's say evaluation of a founder or a founder CEO, which would be kind of my preferred. Also, although significant founder involvement in public companies matters, I think founder CEO puts us in a category that traditionally outperforms the market by a couple percentage points a year. Now, there's power laws in that group, and you want the Facebooks and the debate of whether Elon Musk is the founder of Tesla is kind of a sad debate that I saw a trip across my news wire in the last week. But overall, founders like that with heart, soul, and skin in the game. So I do. So if we just focus on that, okay. So what factors might I look for? The first is I would just watch their YouTube videos, their presentations off their website, read their conference call transcripts. I wouldn't necessarily even need somebody to do that exhaustively over 40 hours of review. Give it an hour, and just start flagging. Do I trust her? What's their time horizon? How much stock do they own? How involved in product are they? Toby Luca just stepping back into the product role at Shopify is a very positive indicator for me. We brought in an expert from Apple, who's no longer at Apple now, but his name is Ken Koshenda, about the Apple product process, which is brilliant and I think is distinct from Google and Amazon and is better. And what you see in the Apple product is you're really getting skin in the game on decision making and owning those results. So if I'm seeing companies or founders or CEOs or executives that are offloading the risk of their business on their shareholders or on their customers or on the environment or on their suppliers, that's a ding for me. I want all boats being lifted by what this company's trying to do. Not that they're going to be perfect ever, and not that they're not going to make mistakes at different points, but that's the real driving heart and soul of the organization. Howard Schultz was an investor in the Motley Fool through his venture fund in the earlier years, and just seeing him and how they treat employees at Starbucks. I'm not saying Starbucks is a perfect organization throughout history, but in terms of a restaurant, like a fast beverage restaurant, the way they treated the people that worked at Starbucks is a cut above. Same thing at Costco. So I want to see that founder has heart, soul, and skin in the game, and it really has a stakeholder-centric view, and wants to be held accountable by every stakeholder. Is not saying, buyer beware. Buyer beware. This is type 2 diabetes in a can, and deal with it. Versus no. We're constantly trying to make our products healthier, more beneficial in every way we can.
Mm-hmm. How important is ambition and like outsized ambition in a CEO or founder when you're evaluating a company?
I think having an expansionistic view on the part of leadership does matter. Now, we can get the smaller value plays if we want, that are dominating their niche. And Walmart began paying a dividend when it was a market cap 20 million. So those are good indicators, and you can find some good value plays by small companies that are very disciplined and that maybe even pay a dividend. And I do believe that they can succeed in the next decade. But overall, yes, I'm much more excited by the executive team that wants to reach more people, serve more people, and grow. I mean, I would say, let's take Elon Musk as an example. Well, let me ask you, do you have anything that you challenge or are discouraged by at Tesla?
Oh yeah, I mean, I have a list of many things that I think Tesla and the team there could do better. But overall, I think they're doing a fantastic job, and that's why I'm an investor.
Yeah. So the reason I asked that is I love the idea of being engaged in the public markets with our companies, and I love the community dynamics that we have through the growing enthusiasm for investing and just our communication opportunities on the internet. So we can influence these companies. And just watching Sandy Munro interview Elon Musk in the last week or so, I was really pleased that Sandy asked about manufacturing at scale, and that there's some unevenness in the cars. And I was somewhat pleased with Elon Musk's answer. I was somewhat pleased. I would prefer that Tesla would do something now to say, if you got a car that isn't up to the standards that we believe in at Tesla, we do have something for you. And that's hard to manage at scale. I don't exactly know how to do it. It's very easy to say it. during an interview, and then just end the interview and say, I think it's a good idea. But it would be hard to execute. But so I want the expansionistic, ambitious CEO who's always trying to fix the mistakes that have been made. And so, yeah, I'm not looking for reckless, acquisition hungry. I'm looking for organic growth, but of course, whenever I can find it, and it's at a very high rate, and management team is saying we have a worldwide opportunity here, and we are reinvesting. That's the best of the best.
You mentioned Howard Schultz with Starbucks. I mean, they've done an amazing job with their culture and taking coffee internationally. When a CEO like Howard Schultz steps down from being a CEO, is that a red flag for you? How do you process something like that? Do you reevaluate your investment in that company at that time?
I think it depends on many factors, but I would say in general, yes, it is an immediate question. But that would be a flag for me. But the larger the market cap, the less impact the CEO has. So the founder CEOs of the $2 billion market cap or even $11 billion market cap are very different than the founder CEOs at the size of Facebook. I think Mark Zuckerberg's probably having less and less of an impact on Facebook than ever before. And if Jeff Bezos stepped down as CEO, and I think Amazon stock was up. So I think that some of it matters where that company is in its growth journey, and then some of it matters how and why they left. But all in all, although I favor the founder CEO, I think that there is something at a higher level than that, and that is a true ownership culture. So if we can find a business where, and I know you've interviewed Daniel Schreiber, and really enjoyed that, watched that interview and really enjoyed it at Lemonade. When you see an organization that customers want to fight for, you'll see out on Twitter, if you type in Lemonade and just start scrolling through Lemonade Insurance and start scrolling, you'll start seeing, when are you coming to Denmark? And this is what was happening during the great growth years of Whole Foods. When are you opening a Whole Foods in my neighborhood? When you're opening a Chipotle in my neighborhood, et cetera. So when the customers want that and want to have a stake in it, feel they own part of the brand and the experience, and they're advocates for it. And then all the way through the employees, and you can go through Glassdoor ratings, et cetera, and try and understand, do those employees feel ownership of the company, or do they feel like an asset, or are they treated like a liability, or are they partners trying to create something? So if I see stakeholders bought in, if the founder CEO is a representative of that for me, and an easy shortcut to it, but there are some incredible companies that are long past their founders.
Awesome. What's the role, or what's the importance of the company's product? Like, for example, how much are you evaluating the actual product of the company? Are you actually trying it out? Are you getting to know all of the other competitors' products, comparing them, talking to customers? Are you doing a deep dive on everything, or are you more just looking at their annual reports and projections? Like, how important is that product itself for you?
It's gaining in importance. I would say that my answer 3 years from now, I think, will be different. Some of that is just the scale of our organization. We have about 60 analysts and about 400 writers, contractors, creators for us. And so you can make requests in those chains to, could you take a look at this? Could you? And so there's more information flow that we want to get. And obviously we want to share with our whole community in the world. So that would be number one. Number two would be to really look at the customer ratings. I would say, for example, with CrowdStrike, take a look at the review. You could have taken a look at the CrowdStrike reviews right as it was coming public, and you see such advocates for that product. So I think I kind of harken back to the earlier comment I made, which is a fun game to get better investing is to say, if I could only look at this factor, the product, and I wanted to try and deliver incredible returns over 10 years, what would I do? Because if we take about 12 of those factors, leadership being one, product being another, capital efficiency being another, et cetera, if we took 12 of them and we tried to master each one of them, go deep in the Dave Lee way, we'd start to see the formulas and the patterns that are connecting across multiple companies. And I think you see with CrowdStrike, with demand for their solution, ratings of their solution, founder leadership, amazing growth rates, capital efficiency, huge demand, tailwinds behind it. Obviously, a different environment than has happened for cybersecurity companies going back 20 years, like Checkpoint. You see companies hit a wall in this category, and now it's never ending, right down to the point where we're going to have a lot of people saying, "Is my home? How do I know if my home is technically secure?" Because I've got a lot of proprietary, person X, person Y, I've got a lot of proprietary corporate information. Where does the boundary line draw on securing that now that people can work from anywhere? And we'll have more and more people working at home. So companies like Zscaler, also founder-run CrowdStrike, look at the reviews, look at the certifications that they get. So it does validation of the customer is, I mean, that's an input to revenue growth, right? Or input to Davner. So we should try and understand that as much as possible. And I mean, Tesla, if we just gone with that, of course there are issues with certain aspects of Tesla, but come on, Tesla, as we know, Tesla customers, if you just follow the customer enthusiasm, it's the level of advocacy for Tesla is like the level of advocacy for Apple. And remember, many Apple shareholders held through the down years, period, because they just believed in Apple. They loved Apple. They felt ownership of Apple. And I think we've seen it with Tesla, and we need to look for it in other companies.
Yeah. What other companies besides Tesla? I mean, you mentioned Apple back in the day. I mean, I totally saw that there was this, this love of Apple and a group of people that just loved the stock, because they had such loyalty, and Tesla kind of does remind me a bit of that, this really belief. What other companies do you see that type of fan base, that kind of loyal, not just customer base, but stockholder base, and who are really just, loving the company and its direction?
Well, the dream is to find them early, so it's not quite clear whether it completely exists. I do think Lemonade has the potential to be a mass market brand and to offer solutions beyond insurance potentially. So I would look at them as an example. I mentioned Fiverr. I think the advocacy for Fiverr is going to grow. I think that in a way, the last 20 years, technology gains for the consumer were about communication, entertainment. I think a lot of it will, by necessity, be about platforms to make money. How can I create and profit and have 5 friends building a game on skills? Or how can we start, if someone's an artist, how can they start providing on Fiverr to companies? So I think that is going to be a enormous next 10 to 20 year experience. So I also think that a number of healthcare related companies will have breakthroughs in this category. I mean, I personally think Peloton is too richly priced right now at $45 billion. Again, because I see the outlier gains driving almost all of a portfolio's returns, I would like to get 30 companies where I believe they could all be 10, 20, 30, 40x, and I'll take my 7 that go down 50%. So it's hard for me to see Peloton as a $500 billion market cap, but that may be the limitations of my imagination. But I do love the question. I mean, for the fun of it, I'll put it back to you. And then as you answer, I'm actually going to click over to my real money portfolios and just make sure I'm not missing any that didn't come to me.
Yeah, definitely.
But what's an example for you?
I mean, one example is in the software developer community that I'm in touch with. The past decade, Stripe has been like the fan favorite. Like, developers just love Stripe, anything finances, and it's one of the reasons why I think they have a great future ahead. And I would love to get into their company as a private investor. Another company I'd love.
Had success doing that?
No, yeah, I've tried a lot, and they're pretty much the most restrictive company I hear in the private markets. Another company I think is huge fan favorites is SpaceX. I mean, you're talking about millions of people who just love this company and love the mission, and it's almost, it actually might be. I mean, I think Tesla has a larger fan base because it's more known, but I think SpaceX might have, in a sense, a smaller but yet deeper. They really appreciate the mission of SpaceX, and what SpaceX is doing with Starlink and to monetize, I think, is underrated. But that's another one of these crazy companies that is just, people don't realize it that it's what they're doing, and that this is actually an investment vehicle as well. Of course, it's in the private markets right now, but those are just a couple examples. I think definitely Lemonade definitely does have that potential. I think long term, if they continue to execute and continue to gain that brand and trust over time, though too. Yeah.
Yeah, and I mean, I would be very happy to build a 30 stock portfolio based primarily on whether they have, evangelists in their customer base.
Mm-hmm.
And I think Etsy is another one. That's also another money making opportunity, but also creative. I think both sides of the transaction are very, very happy on average at Etsy. So yeah, I really love the question, and I think certainly looking in the private markets is also a great place to look, because as Zoom was coming public, we have the benefit as a company of deploying some of these tools before, whether they're a private company or in the public markets, and really seeing the reviews. And when we deployed Zoom when it was a private company, it was probably the most well received application in our that I can think of in our 27 years. So as it came public, it was easy. Their S1 was beautiful. All their numbers were great. Eric Yuan is heart, soul, skin in the game. I just want to make the customer happy. I just want to make my employee happy. I don't want to go back to my experience at WebEx where I was hearing customer complaints and we couldn't fix it, and it just was frustrating. So he had a mission that he was on, and that's so when we find those companies, I think Zoom continues to be one of those companies, and I think it'll be a 10 in the next 10 years.
Yeah. I had a close friend called me last year saying, oh, Zoom is so high, post-COVID, I'm going to short Zoom. And I'm like, you need to watch some of these interviews with the CEO, because this CEO, he's on a different level, he really knows what he's doing. He's executing. Get to know the company, before you bet against it. And so I was just like warning him. I'm curious with Zoom and Shopify and some other companies. I mean, these companies have a lot of growth baked into their valuation, meaning there's expectations, obviously, for certain companies like this. How do you know, or what factors are you looking for to see if they will be able to defend their product superiority, their advantage that they have right now? How do you know that other competitors aren't going to eat that up? And that, because with some growth companies or some companies with high valuations, those expectations are never met. And then you see the company the valuations stall or just, tank after a while. So what are some things we can catch or look at earlier on to say, oh, these are indications that this type of company can actually maintain or extend their competitive advantage over time?
Well, there are exceptions to each of the answers I'll give, but I'd say as a general rule, this is what I look for. One, how much is their growth driven by acquisition? So that's going to be difficult to integrate. Of course, as you become a larger cap company, it's harder to create the new, because how do you have as I said on one of our Motley Fool live videos last night, how do you have a meeting at Microsoft and encourage people to start something new inside of Microsoft? I mean, you've got a $2 trillion market cap. If somebody came forward, as my colleague Bill Mann said last night, if somebody came forward with a $10 billion idea, you'd say, sorry, it's just not big enough for us. So at certain points, companies have to start. And that's one of the unbelievable things about Apple. I mean, it's not an acquisitive company. You can name different acquisitions, but look at it as a percentage of the total value or their balance sheet. Look at Goodwill as a percentage of total assets. I mean, Apple has grown organically all the way through. So I love organic growth. That's going to make me feel great. That makes me feel better about ServiceNow than Salesforce. But Salesforce has been incredible stock, so that would be a factor, a big factor for me. The second one is, are they innovating? So I continue to be nowhere near selling Tesla. My first recommendation really came in partnership with our chief investment officer Andy Cross in 2011, but I didn't start really adding to Tesla until a few years ago in any significant ways, when it was down at 200, let's say, pre-split. And the reason that I did is I have a research partner who went so deep into autonomous driving day, into all of the technical side of Tesla in ways that I don't naturally have that technical expertise, and I don't have enough time in my schedule to do it. And so when I was able to see the technical sophistication of Tesla, it becomes immediately clear to me that all other automobile brands are like magazine brands from 20 years ago. And people can argue, well, these magazines will still be around. And I will answer you, I think they will still be around. I don't think they'll create very much equity value, because we're moving away from magazines, and we're moving away from, we're decarbonizing, and we're moving away from automobiles that aren't software driven? And are these auto brands, name your favorite, the world can name its favorite automobile brands. And I would ask, how are they ever going to catch up with the quality of developers that Tesla gets and the amount of data that Tesla has already gathered? And there are too many things stacked against them. So we have way too many automobile brands now. And I think they're going to just start narrowing. So I want to know two things. Is this the innovator, not the acquisitor and not the follower? Are they still doing 0 to 1, Peter Thiel? Are they still doing 0 to 1 as a large, successful business? And some of these things would, like Apple would win on not being acquisitive, but elements of what they've done have been 0 to 1 in the last 10 years. But a lot of it has been a repetition of the iPhone. So I guess all in all, my default is to continue to hold. But if I start to see the balance sheet weaken, and I just don't think they're thought leaders in their category anymore, I'm going to be willing to just sell portions of that position. I rarely do anything overnight. I'm more incremental buying and selling.
Mm-hmm. With your own personal kind of time allotment and research, do you find like in the past, let's say decade or so, even the past few years, with the increase of information and the velocity of information, like there seems to be so much more information out there in companies and the news, right, following all these companies and investments. But then it seems the news cycle seems so fast too. You know, after a day or two, it's like the news is out. Do you find, like, how do you handle that personally to keep up with all of these companies, all of these news, all of these opportunities? But also, do you find higher expectations from people who look to you or to David or to others, let's say at the Motley Fool, to know like a lot about so many companies now? And has that changed from, let's say, 15, 20 years ago, where are the expectations kind of different?
Well, we definitely have so many more investors active online, sharing their thoughts on YouTube, on Twitter, at the Clubhouse. And that's great. That's a great thing for the marketplace, right? Because we're distributing knowledge. People are getting a stake in the game. 20% of all transactions are retail investors in the public markets. And that 20% is showing in good ways, sometimes in less productive ways, that they're here to play. They're not going to put their money with a wealth advisor who's going to charge them 1% a year and have a bunch of hidden fees. I mean, that whole business needs to be pushed into the water and be replaced by machine learning. So at scale, we can bring fees way down, as Vanguard has done, and make the market accessible to everyone, as we see with, I would really highlight Fidelity as being the purest $0 trade, because I don't think they're selling data to high frequency trading firms. So I think that the marketplace is opening up. That's great. And there are more and more people involved. That's great. Now, if we can start to anchor on the time horizon, data driven, and start saying, like, the average holding period of a stock is 150 days. Let's not do that. Let's not be the 20% of the market that does that. Let's be the 20% of the market that's looking for the great innovators, looking 10 years forward, and trying to fund the best businesses that are going to benefit us. Because I do believe you have influence. Once you start having huge numbers of people that are taking a stake, companies want to hear what matters to those investors, and that's a great thing. That's exciting. So now, in terms of staying on top of all the information, for me personally, once I have the minimum 5-year holding period, which is my default setting, it's mandated in one portfolio I run called the Everlasting Portfolio, which started in 2012, and I mandated we will never sell within 5 years. And we've modified that because I think it's better to have that as a goal and a default setting, but not to limit yourself. Because if you can part ways with some underperformers, maybe make 6 of them that make up 2.8% of your portfolio, so they're all small and you aren't going to add to them, you don't believe in them, and reallocate towards things you believe in. I think I want that flexibility. What I don't want is I don't want people to start their purchase with that mindset. Like, when should I sell? But it's more, how long can I hold? How great could this possibly be? And how much do I want to be a part of it? How much will I learn? Probably the greatest investment across Smarter, Happier, and Richer that I made was the opportunity to invest in the Heights, which was a Broadway show created by Lin-Manuel Miranda, which then, because the producer of it was my college housemate, she invited me to invest in Hamilton as well. And the experience of getting to know the cast, and obviously it's been a wonderful investment in theater, which doesn't normally pay great returns, but that's my mindset on investing in all companies. How much am I going to get to learn from this business, from its products, from its CEO, et cetera. So as I look at all those factors, when I take a 5-year time horizon, all of a sudden 80% of what's going on is noise. If I want to enjoy the noise, like I do when I watch my favorite baseball team, the Minnesota Twins, which the team that has the longest losing streak in the playoffs in baseball history right now, I'm going to watch many pitches. I'm just not going to react to them. I'm not going to think about parting ways with my team because they lose 3 games in a row. I'm bought in for the next 10 years with my Minnesota Twins and probably long after that. And that's how I think about my businesses. So I don't need to hear about every pitch. I may enjoy hearing about the results of every game, but it's not going to change my behavior. And so I think it's just the prioritization methodology that we take for all that information. And then it's an opt-in or out in terms of how much we enjoy the subject.
Mm-hmm. Fascinating. You mentioned how you have 60 analysts and then another 400 contract writers. It seems like an immense team. I want to ask, like, of the 60 analysts, I would imagine there's a few that, they're obviously not all 60 are equal in terms of how valuable the contribution perhaps they provide. And there might be a few that just are complete standouts. Like, for example, if you and David wanted to create something like close up shop with Motley Fool and create something completely new, and you only could pick 3 of your analysts to join you, like, I'm curious, what about these top 3 analysts make them the top 3? Like, why do they provide so much value that you would, want to, pick them over, let's say, the other analysts? And the bigger question is, like, what makes a great analyst? What makes a great researcher? What are the characteristics and qualities involved?
Well, I think this first one comes from Charlie Munger. He may have worded it differently, but it is never-ending curiosity. If I know you have never-ending curiosity, then I know you're not going to rest on your laurels, or you're not fundamentally going to be investing just to make money. So if I find somebody who's investing just to make money, that's a limitation, even though it's the natural outcome of what we're working on. But in the way that the journey is more important than the outcome, I want to know that somebody who is going to be investing a portion of my money is endlessly curious. And I mentioned the Schlosses before. They would immediately buy. I think my sister is the family member of ours who purchased Bitcoin, I believe, at $100. And so I love that. Like, there's a book entitled The Zurich Axioms that I recommend. It was written by a group of people that wanted to study how extreme wealth is created. And one of their conclusions was you need to always be taking small stakes in speculative zones so you can learn about the odds of the world and learn about the innovations, like the periphery of the future. So I would want to know that they're endlessly curious. I would want to know that they're 50-50 quantitative and qualitative. I would want to know that they have some methodology of ESG or conscious capitalism, because we're in a connected world, and you're not going to get away with stuff you got away with 10 years ago, 30 years ago, 50 years ago. You're not. If you're a US-based company and you're doing something in foreign countries that it was very hard to find out about, we got our daily newspaper and that was it. Like, that whole game is over or ending. And so I want to know that my investor, my great analyst, is interested in life and world improvement as part of their methodology for investing. And I'd probably be happy with those 3. I guess never-ending curiosity kind of captures it. But I guess fourth is I want to know, like, is this really what you love doing? Because it's okay if it's not. You can still play an incredibly valuable role as an analyst if you're focused in one thing. If somebody's focused only in ESG, I would want them to have a wider range of interests. But if they're going to be the specialists on ESG, that's why I love having dozens of people, because they can play different roles and contribute different things. But for the top handful, I would want those basic 4 factors.
Awesome.
They're very David Lee-like factors. And you bring curiosity to your every day.
Yeah. I have so much curiosity that I could carry on this conversation for 5 more hours.
The next one we'll do, if you invite me back, is the one where I interview you.
Yeah.
Maybe Emmett and I put you on the spot.
That'd be great.
I haven't met Emmett, but I've seen him out on Twitter, and I've watched a few.
Yeah, he's a big fan of you and David as well. Fantastic guy. I guess final kind of wrap up topic or question is, what type of minimum commitment do you think a person needs to have to be an active investor, meaning to be an investor that chooses their own stocks, creates their own portfolio, versus just being a passive investor in an index, like let's say a low cost or zero cost, S&P 500 or total stock index fund, is there a certain number of hours per week you would recommend, or a certain number of level of interest, or what's that kind of point where it makes it worth it to be an active investor?
Great question. Well, I would say I'll take one middle layer to passive indexing and active investing, which is that we at the Motley Fool believe everybody should own shares of at least one company. And that includes like every 7-year-old should own shares of one company. And we should make that very easy. In fact, government should make it easy to open up newborn accounts where the family can put up to, let's say, $5,000 in the account. And it's never taxed if you hold it for 40 years. The individual, that baby holds it all the way through to age 40. It's never taxed. Well, what happens in our society if that happens? And then everyone encouraged to buy shares of one company opens our mind to what's happening. Otherwise, some of the messages around corporations and how evil and they're controlling society, these organizations are run by people just like government agencies are. And we need to review them. All these organizations need to be held accountable. We need to review them. And we don't necessarily need to review them to try and shame them, to improve them and to improve our lives, to make sure they're serving their stakeholders. So I would say I would like everyone to own shares of at least one company. But you asked about active investing, which is now I'm going to try and build a 30 stock portfolio. I'm going to be reading about this. And I would want to know that you're going to read at least 2 hours a month about your companies and your investment approach. That would be the beginning. Ultimately, if the truly actively engaged investor doesn't see a gap between the analysis of anything and the opportunity to invest time, capital, creative energy, intellectual curiosity into something. So the gap between active and passive in investing is really just your level of interest in your engagement with that material. So I do believe it's a subject open to everyone to become active. But for some people, that is Live Nation because they love live music, and that's a great way for them at the age of 16 to get started investing. And for other people, it is gene editing because they're very interested in what CRISPR, Editas, and other companies can do to change the world. So, but I guess I'll say at least a couple hours of reading a month. I'm not sure I love my answer there, Dave. You asked a great question to end, and I should because we're serving members who are active in this. I do believe, to close, on a mediocre answer to close, I do believe you can invest in individual stocks and not be an active investor. I do believe if you get 40 great companies, let's say, in your portfolio and just hold them for 5 years. I believe Fidelity pulled back the story, so we don't know whether it was ever true, but at least the rumor was that the best performing accounts inside of Fidelity were accounts that lay dormant or were somebody that had died and the family forgot they had an account. So it didn't trade at all for very long periods of time, and it had tax efficient growth. Yeah. So I think there's a passive way to be an individual stock investor. But for the active ones, I'd at least want to know you want to read about it, watch some videos about it, and learn every week and every month.
Got it. Do you have time for one more story?
Of course I do.
Okay.
Because everyone knows I'm going to be late, 5 minutes late to my next meeting. Okay. No such thing as on time at the Motley Fool.
In one of your past interviews, actually a couple of them, I've heard you tell a story of your dad taking you to the store and seeing a product saying, hey, we have stock in this company. Can you share that story of kind of, that experience and what type of impression that made on you and kind of how you look back at that?
Sure. Maybe there are 4 connections I'll make, 4 little connections. One, we'd go to the grocery store. There was a product called Squeeze Me's offered by Norton Simon. You'd tear the top off and you'd squeeze the butterscotch pudding or the chocolate pudding, and it would go all over the place. I don't think in the end it was a great product, but we loved Squeeze Me's as kids. We loved them. And Dad would remind us, we actually own shares of that company. Now, when we first heard that, we had no idea what that meant. But as we learned and made another attachment, Dad saying, well, you're reading the Washington Post sports section. We own shares of that. And Dad wasn't doing that as like a diehard capitalist trying to raise his kid. He was like, it's a game. Our dad and our mom, they loved bridge. They loved games. Our dad loves games, and taught us through games. I think of my uncle was a money manager who, when we played him in games in the family at home, he would win no matter what. He's going to trounce you in Candyland because he's like, I'm not going to lose. I'll teach you how to play the game. I'm not going to here to make you feel good. And I love that. He was competitive and shrewd, and you realize, and so there was a very big game dynamic for it. The third is there were rare times when on a vacation, instead of going swimming that afternoon, we would go to meet the chief financial officer of a semiconductor wafer design company. And on the one hand, that was a little tedious for us on a sunny day where we could be doing something else. But on the other hand, we would get in the car afterwards and Dad would say, "What do you think?" And I can remember situations like, I don't know if I trust that guy, but I mean, I'm 11 years old. And so Dad's putting us in a position to evaluate an executive at a public company.
How old were you at that time?
I was probably 12.
Wow. Okay.
Probably 12. I would really say that David and Dad really connected on investing. I was there observing it. I was probably the one who was a little bit more disappointed that we didn't have an outdoor day. But we would get back from vacation, they'd be sitting in front of FNN, the precursor to CNBC, just like a cardboard set and a ticker going by. And I'm like, this is what we're going to watch. But I think the elements of game, products we like, people running companies, and the ability to put some capital in and see what happens with it, those have been some of the principles Dad taught us to get us in the mix early on.
Awesome. Tom, I wanted to thank you for joining the show here. Fascinating conversation. I appreciate just your openness, your generosity to share your years of wisdom with myself and with my viewers. So thank you for your time.
Thank you, Dave. You know, our mission is to make the world smarter, happier, and richer, and I see you doing it all the time out here. So I hope there are many more occasions for you and the Motley Fool to connect in different ways. So
Great.
Thanks for doing it.
Is there anywhere people can find you on Twitter or on the web? I mean, of course, motleyfool.com for Motley Fool services, but anything else?
They can find me on this program.
Okay, great. Awesome.
Fool.com. We'll see you out at fool.com.
Awesome. Okay,
Cool.
Thanks, Tom.
Thank you.
We'll see you.